Hi everyone, today we'll talk about risk neutral pricing and hope to give you intuition for risk neutral probabilities. So I believe everyone's exposure to risk neutral probabilities is probably through the one period binomial model for option pricing. And typically online resources will talk about the formula and they'll derive the option price using two methods. The first is the hedging ratio, the hedge ratio, or the replicating portfolio. And the second method is the risk neutral probability. So today I hope to go through both of these methods. But in addition, I hope to give you a graphical interpretation of the hedging method, um, as well as I hope to give you a nice segue into risk neutral probabilities from the graphical from the hedge ratio method. So the typical setup is that we have underlying S naught, right? So this is the market price for the underlying. The market is willing to buy and sell the underlying at this price S naught. So this is a market price, it's a 1 point price. So there's no bidder spread, right? Just 1 point. And we're given that there's two scenarios in the one period binomial model. There are two scenarios, one where it's upticks to S naught U and one where it downticks to S naught D, right? And we can assume that S naught D is less than S naught, which is less than S naught U. So yeah. So in the one period binomial model, we do not assume anything about the probabilities, right? We do not know whether it's going to uptake with some probability or downtake with other probabilities. And that's kind of reflective of the real world as well. You can infer what the market says about the probabilities based on S naught, right, in relation to these prices, right, the relative levels. And in fact, that's actually the risk neutral probability, right? But I'll arrive at the risk neutral probability later on. But for now, we do not know the probabilities. So we do not know the true probabilities that it's going to arrive at. Um, and we are tasked to calculate the fair value of a call option. It could be put as well, pretty much the same calculation. But in this case, let's go with call option. And the call option has a strike of K, right? And let's say the K we stipulate to be between the two upticks and downticks, right? So between the two prices is a strike price. And so that means that in the case where upticks, the strike price is lower than the value. So we have the call option pays out. The payoff for the call option is S naught U minus K. And the case where it downticks, um, it expires out of the money. So the payoff is zero. And so now we're tasked to find the fair value of the call option over here. And I'll call the price of the option PC. So typically people would derive the fair value by constructing a replicating portfolio, and they want or some kind of hedge portfolio, um, which they want to be in the same. They want a hedge portfolio to be the same value in the uptick and downtick case and all that. There's plenty of other resources out there for constructing it, for deriving it in those ways. But in this video, I'm going to take a slightly different approach in which I'm going to try to derive it graphically. So I hope the graph also gives you more intuition um, for the derivation and the principles. So suppose to reach there, I'm going to draw three diagrams, right? First of all, um, and the first scenario is we're given a call option for free. So you're given a call option for free. What's the payoff? Right? Suppose it's some endowment, right, given to you by inheritance or just given to you by donation, and the payoff of a call option given to you for free looks something like that, where the angle here is 45 degrees, gradient is 1, right? And this is max of S minus K, where K is the strike price along with 0. So if it expires out of the money, you never need to redeem, you never need to exercise the option. If it expires in the money, then you can buy it at the strike price K, and you can sell it on the free market at the at a price S, and then you gain a profit. So that's if we are giving it for free, but nothing comes for free, right? Typically, we need to buy a call option, we will pay some kind of upfront price, PC, right? And what that look like on the graph over here is it look like it's an offset, a vertical offset downwards, right? by PC, right? So this intercept is minus PC, and the payoff is now max of S minus K, 0 minus PC. Okay, so that's if we are the buyer of the call option. But if we are looking to sell the call option, if we are a seller of call option and we sold 1 unit, then we just need to invert the graph, right? So let's invert the graph. This is minus max of S minus K, 0 DC. So just negative of the graph. Okay, so let's focus on the seller graph right now. Namely, I talked about the seller graph because I feel like it's a bit more in context with what's gonna come next, right? Um, in context of like what typically happens in the market where you are a seller of something and and um and then after that you want to hedge. So suppose we are a call option seller and we manage to sell it. Suppose we sold it at some price PC or we do not know yet, but we sold it at some fixed price PC. And now we want to hedge our and now we're looking to hedge our portfolio. So when we sold the option, when we sold the option, our payoff something like that. And suppose so our payoff looks something like that after selling the option, right? So we sold the option and now our portfolio looks something like that, right? And in the one period binomial model, there's only two possibilities for the price in the future, right? So the t goes to 0, this t goes to 1. There's only two possibilities. So we are actually only concerned about 2 points on the graph. So suppose that one of the points is here, that's not u. And suppose another point is let's say over here. Sorry, this is supposed to be it's not d, and the other point is s not u. And so what we can see is that as a seller of the option, we actually do not want, as a seller of the call option, we actually do not want the price to tick up, right? Because if we tick up, then we'll actually be making a loss. So we sold the call option at price PC, right? And we actually want it to stay out of the money so that we should never have to pay out. We never have to pay the we never have to pay the strike price. Um, so if I sold this option, um, I now have some what we call negative delta exposure. If we look at these 2 points here and we draw straight line between them, this graph has a gradient, it's a negative gradient. It means that generally it means that the higher the strike, sorry, the higher the underlying, right? When the call option expires, right, the higher the price of the underlying, the lower my payoff. And as a call option seller, I do not like this, right? I want it to be, I want to be more in, I want to be more, I want to be able to not care about the price of the price movements, right? And how I can do so is I can perform hedging. So we go back to the free market over here, right? So right now we are at this time, we just sold one option. I look at the free market and I see that, hey, there is one, that there is, I have an ability to transact with the free market, um, buy or sell this underlying, right, at this price as not. And so that motivates me to buy some of the underlying, right? And specifically, the amount that I'm going to buy is going to be dependent on the gradient over here, right? So if I want to move these two down so that they are the same level, right, then I need to look at this gradient over here. And this gradient over here is minus h, right? Where h is the rise over run, so h is going to be the rise over run, which is s not u minus k over s not u minus s not b. So I'm going to calculate this rise over run, right? These are all quantities that I have, right? Based on here, right? These are all quantities that I have, and I know the hedge ratio that I need to use. So I'm going to actually buy hedge units in order to hedge out this negative delta exposure. I'm going to buy hedge units of the underlying. So what that looks like, if I buy H units of the underlying, it's something like this. So if I buy H units of the underlying at the market price right now, S naught, then this is going to be minus H S naught, and the gradient is going to be H. And so what do we see now, right? We see that if we add our call option exposure, right? We sold one call option and we had this negative delta exposure. We add this graph, this red graph with this blue graph. So I went after selling the option, I intentionally went to buy intentionally went to buy H units of the underlying, right? H units of the underlying, right? So this is my sold call option. If I add up these two portfolios, I'm going to get something that is very nice, right? I'm going to get that it passes through these 2 points, right? So it's going to look something like, I'm going to try to my best effort to draw it. It's going to look something like this here. At this point, it's going to go back down. So this is my combined portfolio, which is the red plus blue, red plus blue, right? So I take the red graph, I add the blue graph, right? And now what do I see? I see that I don't care about the underlying movements anymore, right? If the underlying ticks up, I make $0. If the underlying ticks down, I make $0 as well. So I've perfectly hedged out my position, right? I've perfectly hedged out my deltas. And that's what generally finance firms are trying to do, right? They pick up some positions, right? And they're trying to hedge out their positions. So um this diagram allows me to calculate the PC, right? Remember, we didn't really know what the price of the call option was, right, when we sold it. But now looking at this diagram, we have enough information to derive the price. So this intercept over here of the purple graph is PC minus H S naught. And looking at this graph, looking at this rise over run over here, look at this triangle, we see that PC minus HS naught divided by the run over here is S naught E. This should be equal to H, right? And we have the H over here. So substituting it in, um, you do a bit of algebra, you're going to get PC equals to S naught U minus S naught D, S naught U minus K, um, S naught minus S naught D. Yeah, so we get that this is the price of the call option if we wanted these 2 points pass through zero, right? If we wanted these 2 points, if we wanted our payoff to pass through zero at S naught D and S naught U, this is the price we need to set for the call option, right? If it's any higher, right, then the graph will be higher like this. And that may sound good as a seller, but suppose it's a two-sided price. So suppose that this PC is something that we're offering to buy or sell, right? So we're offering to buy the option or sell the option at this price, then that necessitates that it passes through zero. And so this is the fair price of the call option, right? So we have found out the fair price of the call option over here, right? Based on the following inputs, based on the uptick, the downtick, the strike price, and most importantly, the market price, right? And I'll talk more about this very soon. So what do we see here? We see that with just the market price, the uptick, the downtick, and the strike price, we managed to calculate the option price. And what we did not need we did not ever need the actual probabilities, right? And we did not actually need the probabilities because um, we 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 did not actually need the probabilities because we found a way to hedge it out such that in both scenarios the payout is zero, right? So it's like if the outcome doesn't matter, right? If we found a way to hedge it such that the outcome doesn't matter, and this hedging method doesn't depend on the actual probabilities, um, doesn't depend on actual probabilities of these outcomes, then then our price doesn't depend on the probabilities of the outcomes. So this may seem unintuitive at first, right? But at the core, right, it's because of this market price over here, or for the underlying, right? And 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 more on this, right? Just now I said that we don't know the true probabilities, but based on the underlying price, the market price for the underlying as not at this time t equals to zero, we may infer some kind of implied probability, and that implied probability is precisely the risk neutral probability. So that's what I'm going to talk about now. So if we look at this formula and stare at it for a bit, right, we see that there's a denominator here, and I'm going to draw a diagram here I'm going to repeat the same diagram, right? So it's S naught, and what do we see here? The denominator in this case is the difference between the S naught U and the S naught D, right? It's the difference between um the two prices possible, the two whether it's uptick or downtick. And then what do we see here? We see that the purple part, S naught minus S naught D, is the market price for it now minus the downtick, right? So there's this difference over here. And if we look at this S naught U minus K, that's the value of the call option here. And so what does this kind of tell us? If we look at this ratio over here, we kind of isolate this ratio. If we isolate this ratio, we see that um, this ratio is actually, because S naught is between S naught D and S naught U, right? If we call this ratio pi, right, it's between 0 and 1. And this ratio is actually the risk neutral probability pi of the uptick, right? So we derive this equation without any mentioning of probabilities at all. But when we look at this formula and we stare at a certain part of the formula, we see that it kind of looks a lot like an implied probability, right? This is some kind of this is a market implied probability. So we looked at the market price as naught, and the market price implied that the uptake has a probability of pi, right? Um, this is the probability that will give zero EV, right? If the parties were risk neutral. So under this framing, we can see that the price of the call option may be thought of as a expected value, expectation under the risk neutral probability measure, right, of the call option, right? And this reframing, this change in perspective is one that kind of brings us further, right? Because we went from just staring at this formula, which is just a bunch of constants, right? And now we're interpreting it as something there's a bit of a deeper meaning. So we price the call option as if we knew about something about probabilities, right? But in reality, we know nothing about the true probabilities of whether uptick or downtick. Right? We still do not know, and we'll probably never know. But we can use a mathematical trick by staring at this formula. We we can look at the market price and infer some implied probability and price our option based on that, right? And we are pricing our option based on that because even if we are wrong, right? Even if we are wrong about the true probabilities, even if pi is not the true probability of an uptick, right? Because the market was there to help me hedge out, right? I do not actually care, right? I do not actually care whether it uptick or downtick, right? Because the market um was trading at S naught, I had the ability to hedge my stored call option, hedge my positions such that I had the ability to hedge my positions such that I do not care about the outcome of the market, right? So that's the risk neutral probability. And this risk neutral probability is derived not from first principles or anything, right? But it's derived from the observed market prices for the underlying, right? That the S naught that we're seeing, the two-sided, the single point price, right? That we see trading in the market. And so generalizing this idea, right? When people talk about risk neutral measure, right? They say expectation under the risk neutral measure. Um, what that means is just generalizing this risk neutral probability from these two cases, this binomial model, to many more possible outcomes. So yeah, so I hope that this perspective has I hope that this has given you some intuition for what the risk neutral probability is. And there's this nice video um about this guy explaining an analogy, right? And I find that it's a very good video. I encourage you to watch it. It's a very nice video because it has a very nice parallel with finance, right? Finance is all about managing risk. And the reason why the finance industry exists is to help value generating firms, right? Value creating firms to manage the risk so that they don't manage the risk with each other so that they don't go bankrupt. And so I have a nice maybe I have an anecdote to share, or rather an analogy to share. Suppose that there is a 50% a fair coin, right, that flips heads or tails, and the 50% of the time when it flips heads, you get $70 million. And 50% of the time you lose $30 million. Right? So question now is, will you take up this? Will you engage in this bet? Right? Nothing, no tricks, right? This is just real probabilities. And so the EV in this case is 20 million of EV. Right? Will you take 20 million of EV for free? Right? Um, and and the mathematical correct answer is probably yes, right? Um, but in reality, most of us will not take up this trade, and the reason is because if we had, let's say we had $20 million right now, our net worth is $20 million. If we take up this trade, we are saying that in 50% of the time, our net worth is going to jump to 90 million, and the other remaining 50% of the time is going to go down to minus 10 million. Right? And so if we're already living very comfortably with $20 million, chances are you do not want to take a risk of going bankrupt, right? Um, $90 million sounds great, but um, there's diminishing marginal utility for money, and chances are that your lifestyle change is not going to be too great. So most likely you do not want to take this trade. And it's because you are risk averse, right? You do not, even though it's positive EV, you as a risk averse individual, there's a lot of risk involved here, a lot of variance, and you do not want to you do not like this, right? And in fact, the mathematical way to quantify this is via the Kelly criterion. The Kelly in this case, you plug these numbers in, right? The Kelly says that you should bet 2 out of 21 of your, which is around like 9% of your net worth. And if your net worth is 20 million, then this is definitely too much to bet. So, um, so as for whether you want to take up this trade, the answer should be it depends on your net worth. So this is kind of analogous to a lot of finance firms out there, or rather, not just finance, but value creating firms like mining or like oil or like farming, right? If you're a farmer, you do not want your you do not want your payout to depend on the weather conditions. If you are a mining company that mines oil, you do not want your payout to be dependent on macroeconomic situations like the Iran crisis right now. So, um, so companies do not like risk, and if a company, and let's say some entity comes around and offers to take up your risk, so maybe we can think of two possibilities over here. One is where a billionaire comes along, maybe he has $10 billion, and to him, this is well within his Kelly, right? And he offers you, um, for this $20 million in EV, he offers you $10 million, right? He offers you $10 million for this coin flip, and now you have the option of selling your risk to him, and now the other option, right, is a risk-free $10 million, right? But you lose $10 million in EV, right? So now you get guaranteed 10 million instead of 20 million EV, and I think both of you guys are happy now, right? So he gets $10 million in EV, right? And it's well within his Kelly, so he can play this game, and you get $10 million risk free. And so you have sold your risk to him, and both parties are happy, right? So I guess the rich does get richer because they can afford to play these high variance games. Um, but that's not the only case. That's not the only entity that might buy it from you, right? Not just the rich. Another possible entity would be something like a hedge fund, right? So the relevant concept over here is the capital asset pricing model, CAPM. And the idea is that they would buy this coin flip from you, and okay, this kind of energy kind of breaks down over here because the coin flip is uncorrelated with other assets. But imagine the hedge funds, maybe they buy some stocks here and there. Um, yeah, they invest in a basket of goods, and maybe they might invest in an ice cream company, and umbrella company, and maybe a car company. And among these goods, there's different correlations, right, of their asset prices. So maybe a hedge fund might buy an ice cream company as well as an umbrella company, so it is hedged out against the risk of whether it's good or bad, right? So in a rainy day, the umbrella company does well. In a sunny day, the ice cream company does well, and their variances cancel out. So that's what hedge funds do, and the whole theory behind it is the Markowitz uh, Markowitz portfolio theory. William Sharpe won a Nobel Prize for it. So that's the idea of constructing a market portfolio, um, and the idea of beta and all that. So hedge funds are very good at managing risk. They will be willing to take on um, what other people deem risky, and they take on a bunch of these, right? And then they kind of the correlations kind of cancel out, and now they have a low risk portfolio. So so there's two kind of entities that might buy this kind of risk from you, um, and you can imagine that by transferring risk around like that, um, an external entity that saw this coin flip, right? Imagine they did not know the probabilities, right? They did not know the actual true probabilities. Now we stipulate that it's actually 50-50, but they did not know the true probabilities. Um, and they just saw that you sold it at $10 million, right? And so what the risk neutral probability means is that if they see that you sold it at $10 million, that's the market price that it's transacted at, right? And if they assume a risk neutral seller, right? Right? So some seller with this toxic position, high variance, right? But if they assume that the seller was risk neutral, then they will actually infer probabilities um of 40% and 60%, right? They actually think that conflict is biased, right? If they see you transacted at $10 million. So I hope this drives home the difference between the risk neutral probability, which is based on the observed market price, right? The observed transacted price in the market, right? Between the seller and the buyer, right? The risk neutral probability is based on um, the observed market price as well as the assumption that the seller was risk neutral, right? So that differs, that can totally be completely different from the true probabilities, right? In this case, which we stipulated to be 50-50. So typically, um, the price at which a risk averse, right? If you're a risk averse seller, you are a risk averse seller, and you're held with this like high variance, you have this high variance position, and you're a risk averse seller. You do not like this variance, right? You're like, hey, I really hate this toxic position. This conflict of mine is giving me headaches, right? Please take it off me. In fact, I'm willing to give you some EV for it, right? I'm willing to lower my price, right? So even though it's $20 million in EV, this coin flip, right? The risk averse seller was willing to sell at $10 million. So this was the transacted price, right? Whereas a risk neutral seller would sell it at $20 million only. So that's where the term risk neutral comes in, right? It assumes that the seller, right, is risk neutral, is oblivious to the variance. Right? It doesn't care about the variance. And if the risk neutral seller didn't care about the variance, then that will imply a probability of 40% and 60%. So over here, I glossed over the risk-free rate. I set it to zero, but in reality, the calculation really doesn't change much, right? The only difference it might make is that if it's 20 million and 90 million and minus 10 million, right? Perhaps if the risk-free rate was, let's say, 50% per annum, and let's say this is over 1 year, then instead of calculating the risk neutral probabilities using 20 minus 10 million, right? We will be using 30 instead. So the formula it just affects the discount factor. The math doesn't change much. I don't think it changes the intuition. So I didn't choose to focus on it in this video. And so to wrap up, the beauty of risk neutral probability measures is that um, we started off with a calculation of the option price from the idea of hedging, right? And from that, we realized that we arrived at a formula that we can kind of interpret in a certain way, and this interpretation actually generalizes to um, a lot of other broader types of derivatives. If so the risk neutral probability is kind of like a conceptual calculation trick that allows you to look at the current market, calculate the observed price, look at the observed prices, and calculate associate certain probabilities with certain outcomes. And using those probabilities, you can calculate all kinds of the fair value of all kinds of derivatives, right? In a way that prevents any form of arbitrage. So that's the beauty of the risk neutral probability measure. And in fact, it's so deeply entrenched um, in the fundamental theorem of asset pricing, right? And its second theorem says that such a measure exists if and only if the market is arbitrage free. So there's a lot of financial math theory backing this. But I hope today I gave you a small glimpse of the intuition behind this risk neutral probability measure. So I hope